Hello, and welcome to the Bitcoin Review podcast. This is an ad-free pod. Thank you so much for streaming those sats. Hello, today we're doing an episode on chain analysis, and this is not the Mayo astrology style of chain analysis. Although they will all have to give a price target and commit to that or eat some crow. I'm just kidding. Anyways, so I'm pretty excited about this group of guys here. They seem to know what they're talking about. And hopefully we can get into the weeds of some of the chain analysis stuff that is not making charts. All right, so I have today Mr. Checkmate returning.
Hey, folks.
Thanks for coming. For the people who don't know you, what do you do?
Yeah, so I'm the lead analyst at Glassnode, lead astrologer, however you want to call it. It's essentially what I try to do is understand what the hell Bitcoin's doing, why it's doing it, and the emotional and I guess you call it behavioral economics behind what the big beast is doing.
Very cool. Very cool. We got your stuff now on the block clock.
I know. That's it's a strong addition. I'm literally going to add it. I got home yesterday, so I've got both the micro and the mini I need to get SOPR up on.
Yeah. Now you can see how much Bitcoin is on WBTC and see how much Bitcoin shouldn't be there. Mr. Permabull, nice to have you.
Yo, hey, thanks for having me. I'm excited to be here.
So what do you do, sir?
So I am the head of research at a hybrid hedge fund / venture fund called Spacewell Capital. We do long-term investing for projects that we like at early stage investments, and then we also do liquid trading strategies. And I do a lot of the data analytics for the fund, and simply put, help us make better decisions when it comes to allocating capital.
So you're saying that you have some skin in the game?
I do. I've got plenty of skin in the game.
Okay, Mr. TXMC, thanks for coming.
What's up? Thanks for having me. Excited to be talking to you guys.
Yeah. So what do you do, TX?
Well, I have a full-time job that is not related to what we'll be talking about today. But I'm just kind of an analyst, a curious person, a palm reader, I guess. And, I know these guys because, I got into on-chain last year, and I just kind of been fascinated with Bitcoin and trying to learn more about it over the last few years. And it led me to on-chain and, the behavioral market psychology aspects of the things that it shows are really interesting to me. So I make a lot of charts and post about them online, and that's about what I do. Very cool. So I think, like back in the day, we used to have, when people talked about chain analytics, we were talking more about chain analysis, the company kind of thing, right? Where you're trying to, pretend that that those guys have coins that they shouldn't have and acquired by means that the state does not agree with. I think that sort of has come a long way and sort of like diverted into different sort of aspects of looking at the transactions which are public and finding some heuristics there where people can infer, right, some ideas of what's going on, right? Like in terms of in the network itself. So Checkmate has a company there that I think changed personally my mind into the quality of that inference. I think we arrived at a place now where that is no longer astrology, right? You can definitely come to some conclusions that have some teeth. And I think they were fairly proven in this last bull and bear market. I think this was the cycle that sort of proved that this technology does have some good answers. So Checkmate, do you want to give sort of like a little bit of a primer on what is the kind of chain analysis that we're talking about with the three of you? And just technically speaking, like how do you guys do some of that inference? Like, we don't have to get into the weeds, but just sort of like people understand that we're not just sort of like, reading the tea leaves here.
For sure. Yeah, I mean, the way to think about it, so Bitcoin's basically a big database, right? And it's looking at who owned what and when over time. And, the analogy I like to use is that imagine if you could see all the money moving around the SWIFT system. You could just see them as packets of money. You could see the size. You could see that there was an entity. That one over there is JP Morgan Chase. That one over there is Investment Bank X. If you can see that money moving around the system, do you believe that you'd be able to infer some kind of, macro data about what's going on? And the answer is yes. So you take the database that is the Bitcoin blockchain, the UTXO set, and you essentially, that's just raw data. Now, naturally, we all know that you can have multiple addresses and, each spend isn't necessarily economically viable. But as with all data, you start with the initial data and then you go through a process of actually cleaning it and then parsing it. So you take that information, you work out, okay, we know that all these wallets behave, look, smell like Binance. Every time we deposit to Binance, my coins end up in this hot wallet. So you go, well, it's highly probable that these are all Binance. So what you can then do is say, you can remove all of Binance's internal shit, right? And what you're then doing is turning it into actionable information. So once you've got your various clusters, you now have a bit of a scope on entities and coins going in and out of exchanges. And then what you're looking for is that behavioral economic side, right? So you've got your known entities and then you've got everyone else, right? The plebs. And the plebs, whether we like it or not, there's kind of two cohorts. There's people who've got stones of steel and can weather Bitcoin's volatility. And then there's folks who are going to capitulate at the bottom and they're going to buy the euphoria at the top, right? That's all of us at the start of our journey. And, you just it's a grading curve between the bottom and the top. And I think the right frame of reference is this time is always different, but the human beings trading the markets are not. The emotional response of human beings to fear and greed is as old as time, right? As old as price.
How confident are you on the owner of the coin and the knowledge, like knowing that is the owner of the coin or a type of owner of that coin, right? Because, I imagine with the exchanges, it's not that hard, right? Because they have extremely poor UTXO management and a lot of them custody with other exchanges too. And then they have all this cross balance sheets that's a fucking mess too. And that's not even touching the shitcoins, right? Which it's even more clear because there's a lot less owners too. So with exchanges, we kind of get it, right? Like it's somewhat there, I imagine that you can find yourself a good, like above 50% certainty. Mm-hmm. Now, what about the sort of independent businesses, private actors in general, right? Like especially small owners. How do you get to that data?
Yeah, so generally speaking, unless they're noteworthy enough to be following, right? And that's where I think glass nodes will differentiate from chain analysis quite significantly. Once you get down to small entities, unless you're notable enough that people would actually want to know funds are flowing in and out of you, like Coinbase, or miners, which is just really easy to identify based on they put stuff in the block header. Generally speaking, they don't show up. Now, there's some entities that, people are like, oh, hey, do you follow, Fidelity? It's like, well, not yet, but maybe, right? Or maybe in the future, if their cluster becomes relevant enough to follow, WBTC, it's worth following because there's, 1.7% of the entire supply there. And more importantly, the flow of funds in and out of that is meaningful. So the answer is there's a grading curve, even on exchanges. Some of them are much harder to track than others. So it's a process, and as with everything, there's always a confidence interval. But at the end of the day, if coins are moving, that means that they're active and alive. If coins are not moving, it means they're inactive and alive, and you can discount and account as you go from there.
Well, one interesting aspect there is that I always find is how do you guys calculate who's the percentage of people who are under, who are now at a loss? Because that's a chart that I see sort of passed around a lot and seems to be something that is talked a lot about. Is this something you look at, TX?
I do look at it. I mean, the supply and loss is really just a reference point to the last time the coin moved and what the price was at that time. And with the presumption that every time a coin moves, even though we know that there's an air gap between the ledger and the liquid market in a lot of instances, there's a psychological reference point, like a bookmark in the mind for when you interact with your coins on a given day and what the price is at that time. So you can make in the aggregate, to Check's point, on an individual basis, there's more noise, but in the aggregate at scale, you can make inferences about the percentage of supply that is or is not sitting in profit based on when it moved and what the price was then compared to today.
right? How do you discount people just sort of, this was a question that I posed to Checkmate like probably a year or two ago, I think on Twitter, was like, how do you discount all the OGs just sort of like moving wallets or, like just UTXO management generally, because everybody does it, right? Like it's very rare that you still see coins days destroyed to be super old, right? Like things have been substantially moved around. And I imagine when you go take a peek at Unchain and Casa under their pants there, like under their skirts, a lot of that, like a lot of coins destroyed went there.
Yeah, so then there's a few ways to think about it, but at least from my view, the longer a coin is dormant, the more likely it is to stay dormant, and the longer it's dormant, the more likely it's lost. So the fact that Casa and these guys keep moving their wallet management, there's a few angles to this. One, that's telling us the coin is still alive. It's not dead, it's not lost, it's not, boating accident. The other one is that if you've got metrics associated with it, so I think the two ways to think about it, you were talking about profit and loss before, that's what we call price stamping. You price stamp the coin, the UTXO, at the time it's created, and then you re-stamp it either today, which is an unrealized profit or loss, if they still haven't spent it, or if they do spend it, it's a realized profit and loss. And you just measure the delta between UTXO creation and destruction. Now, if Casa's moving coins around, you can just, and it's Casa, you can just say, this is what entity adjustment is. You say, I don't care that Binance realized $1 billion on this cold wallet spend because it's Binance sending to Binance. So you can literally scrub that data out and only look at the meaningful information.
Now, when you're referring to dead coins, there is a lot of people out there that have piles that they move and piles they will never move, right? How do you discount for, what's perceived to be, say, dead, but it has a high likelihood that is not lost?
So there's price stamping, and the other one is time stamping. So you can also time stamp these UTXOs. That's where your coin days destroyed comes from. And, to be honest, it's kind of a grading curve. And we do have metrics actually that really explore this concept. How alive or dead is the coin supply, right? Liveliness is basically what that is. It's between 0 and 1. How much of the coin supply has destroyed all of its coin day accumulation? So, and vice versa, how much of it is completely stationary. So these things are always moving. It's a moving target, but you're essentially using metrics to track the time stamping and the price stamping, which gives you, as markets move through these cycles, you see that most OGs who are going to spend have a profit that they finally go, yep, that's it. That's my price. I'm taking my money. And likewise, at the bottom of a bear market, there's a point that human beings can take in pain, financial pain. And when you hit that point, generally speaking, you exhaust all the sellers, and you're looking for in previous cycles, where does it happen?
And is this on a Pareto kind of distribution? Would you say that those sort of rule of thumbs that you're describing, right, are those sort of on an 80% basis kind of thing? So 80% of the OGs will find a price that they will sell, but 20% of them don't move ever. Like they are not going to sell no matter what. Would you say that sort of kind of applies?
Yeah, and that's why a lot of the you end up with a lot of oscillators, right? MVRV goes between certain extremes. Once you get to 3.2, right, when everyone's in 320% profit, some guys start selling. It just happens every time.
Yeah, I mean, price action unlocks supply.
Well, also another thing that people need to consider when it comes to on-chain analysis is a lot of people like to look at these metrics on an absolute basis, right? Like, for example, people like to look at fees, right? People are like, oh, the fee market looks relatively low right now. But what I've been looking at in my own metrics is that the fee market is relatively lively. And it's kind of similar to like an order book, right? If you're going to sell $1 of Bitcoin, every single time you do it, it'll move the price a different amount. And that's kind of how the way you need to look at some of these metrics and realize on-chain is not only should be looked at as like a balance sheet and like stamped at one point in time, and it only behaves one certain way over the entirety of the Bitcoin network. In reality, it's like, it's kind of like a biological living being that its behavior shift over time. And you need to take that into account when you're doing some on-chain and like analytics, right?
Yeah, I mean, that is true. You can see that with the, essentially with the fee market, because when you have a bull market starting, right, the fees are going to go up because those blocks are going to get full because you have retail coming in. Right? It's not institutional that fill up the blocks, right? I mean, institutional are just buying and selling IOUs between each other anyways. And if they do move on chain, those would be large single transactions, right?
Exactly.
So, and we'll keep on seeing this forever, at least it's my view, right? You're always going to have this sort of like lulls where you're going to have empty blocks, right? And like I am on one sat byte kind of guy to make transactions, even if I have to wait a month. But, you're going to have people who have the economic need to move that coin immediately, and they'll pay whatever it takes. And that's just going to change as you have more people using the network.
Yeah, that's what's really cool about fees, is that it takes into account like three things, right? Volume, urgency, and cost, right? And the fact that the data actually costs something to imprint it onto the blockchain makes you know that over time, it's actually going to be consistently a reliable signal for demand to use the Bitcoin network, right? And let's call it what it is. People, like keep in mind, like I work at a hedge fund, right? It's like I also dabble in altcoins, but I feel like over time, especially in bull market,
we call that shitcoiners.
Yeah, sure. I'm a shitcoiner. I'm completely okay with that. Proud. But, a lot of people over time, especially in bull markets, they like to discount Bitcoin and the need and utility for it. But let's call it what it is. The second Bitcoin topped, everything else in the crypto market topped, right? That's why Bitcoin on-chain analytics is such a big deal, right? Because it's the rising tide that raises and sinks all boats, basically.
It's the climate, and all the shit coins are just shitty little weather systems floating around it.
You have the sea of liquidity, which is Bitcoin, right? And then shit floats, right? You have all the shit coins floating on top of the Bitcoin sea of liquidity. As the Bitcoin wave goes up, right, it brings everything up and down in the same sort of thing. And then when you have the storms, some things get forced down, but eventually they pop. But what's so interesting about this is that we now have all this visibility, right? And we had this extremely exuberant bull market that was actually not really followed by the price. The price was substantially lower. And there's been a lot of discussion about essentially FTX was able to inflate the Bitcoin supply by a substantial amount, like some people talking about 25% for that period. And that was part of the reason why, say, Bitcoin didn't get to a higher price, aside from all the other issues, right? CME shorts and all that crap. Essentially, we have like a price suppression environment for Bitcoin. Have you guys looked at the amount of inflation that FTX caused, due to all the paper coin that they had that was already sold anyways?
Yeah, it's hard. That's probably pretty hard to calculate. But I think it's fair also because of the recency bias of what just happened with FTX. Like everyone's looking to them as the villains that caused everything, right? And they're trying to fill in questions they don't have answers for with the recent events. But really, there were other things that happened during the bull run that may or may not have been related to Alameda or not. The grayscale arbitrage was a huge driver of price in the end of 2020. There were periods of months there where grayscale as an entity was acquiring more Bitcoin than all other non-exchange whales on chain. If you filter those entities by 1,000 or more Bitcoin, grayscale was earning just as much Bitcoin, acquiring, sucking it up, compared to all other whales at the time. And that ARB was really driving price. And as soon as the premium went negative, the price action kind of curled over, it Bart Simpsoned, and derivatives kind of did the rest until we fell over. So there were other factors playing into that. Maybe FTX, because of the paper aspect and the falsification of their reserves, like maybe that played some factor. I don't have personal insight into that, but I do know that there were other aspects of the bull run that I think should get a lot of credit as to how price got manipulated so high, and then also maybe explain why when those factors left, there wasn't really much underneath the market beyond that.
You actually kind of nailed this at the end. In the middle to end of 2021, the fee market went to zero basically for Bitcoin. And you could almost make the argument that Bitcoin stayed high for way too long. We were probably like in a legitimate bear market starting towards the end of 2021, right? So to some extent, like blaming it on FTX, it was like kind of an exchange-driven pump towards the end of 2021.
Agreed.
It absolutely was.
It was the first time we had two peaks.
And so that's the thing. So the on-chain activity is an amazing indicator that I think a lot of people discounted, right? And even myself, but I started at Glassnode in February 21, right? So it was about 3 months of that topping formation, and then we're into bear market city. But I do believe the bear market started in May, and as Jordan said, the fee market just absolutely went off a cliff. If you look at very simple metrics like active addresses, transaction counts, when you have that initial sell-off from the 2017 high, it just absolutely craters. You wipe out, many, many months worth of growth. Then it's a slow grind higher. We had the exact same event in May. And when you look at a huge number of like topping formation models, what normally happens at the top? At the top, you have the largest number of new buyers, which also means you have the largest number of OGs selling. And that shows up in massive coin day destruction, massive realized profits, and it's literally top buyers. That peak was actually the January high, 2021, right before Elon bought. So in my view, as TX said, I think there's a lot more going on. The second pump in November 2021, yes, arguably, I would give more credit to that being an FTX style fake pump. But what happened in January, I think Elon basically stepped in and alt season just went on. The whole Dogecoin thing, I think, just turned the whole market. People drained out of Bitcoin. And back to Jordan's previous point, the weather started turning bad, but no one saw it because they were too busy punting in the jungle of Doge. So that whole escapade then blew up in May. And I think that's when that scam pump actually rallied to all-time high because nothing else followed through on that.
Could you say that, because Duke One had, 50,000 coins, I think? 80,000. And his positions were being pursued by FTX publicly. When we dropped to that 28, the first drop, right? At least like from anecdotal sort of chatting around through, people who were running some of these institutions, like it really felt like somebody was trying to save positions everywhere. People were like, at least the large players were trying to save their longs, and sort of there was a lot of buying to cover. And that's why we got a second peak. I don't want to get into the sort of like the price weeds per se. It's just, I'm just interested in the mechanics of what's going on here, and like your expertise on like what could we actually see through that chain analytics of like what's actually happening as opposed to, like just anecdotal crap.
Yeah, it really did show the momentum of the market. Like Check was hitting on something that I've found really fascinating. And I think, on-chain as a, space didn't do a good job of representing it in real time. But in hindsight, it has learned that the peak of the market was really in January. That was the height of all activity on chain, the height of active addresses, the height of long-term holders spending coins, like the height of really anything. That was the maximum block space demand. All that stuff was in the early part of the year, and the Elon candle really kind of sent us into a weird derivative space. At that same time, like right when the Elon candle arrived, you see leverage on Bybit go insane relative to the market, relative to all the other exchanges. Futures leverage compared to the market went crazy on Bybit to the long side. And that's when we started getting a lot of those, squeezes up and down at the top there. And in the second half of last year, almost none of that activity was represented on chain. And if you go back and you look at some of my tweets, and maybe some of these guys too, at the time I'm tweeting out like we're rallying, that the market is going higher, yet on chain is saying that there's no one here. This is a ghost town. Everyone is just hodling at the base layer. And so whatever this is going on here, this is happening purely in the market itself. And it looked bearish. It was a bearish divergence, but it created an all-time high.
Yeah, and there was two elements to it that I noticed. And again, these are really simple models, right? These are pretty accessible for most people. But active addresses. If you just envision you've got your peak in January, the bounce back, how many people came back into the network was substantially lower, even though price was at the same all-time high. And the other one is any of our like MVRV or profitability metrics. And what you saw is that the amount of unrealized profit, how much gain did the system have still stored within it at the April peak, right? When Coinbase went public versus the November peak was much lower. So how do you have price at a higher level, but there's less stored profit in the system? Well, that's because some guys took their money out. They literally took profits. So thus you have less stored energy, massive bearish divergence. So these things are, and again, even for myself, the analyst I am today is orders of magnitude better than I was back then because I've spent, now two or something years, spending every day in the data. When you've been in Glassnode's tools, there's so many of them. And I was there for like 3 months when the market blew up in May. So you're trying to kind of learn as you go. And remember the whole on-chain space, it's very memeable. But like all sports, right? If we go and look at all the TA charts, you don't want to go look back at someone's TA charts from 2 months ago. They're dog shit. They don't do anything. So there's some guys who do it well, and there's some guys who just don't, right? And that's just the game of proof of work, right? You have to do at least some nominal effort to understand what these things are doing. But we're constantly learning, and that's part of the process.
One thing I think that was really different about this market and that we should keep in mind the next time we have a bull run is something was very different this time around from the peak in 2017, which I wasn't even in Bitcoin for at the time. The bull run back then, first of all, BTC was the trading pair for much of the altcoin market at the time. That ceased to really be the case after that bull run. And as well, we had the proliferation of stablecoins. As well, the CME futures opened up in the bear market. All of those things were new, as well as the expansion of BitMEX. All of those things really developed and matured in the 2018-2019 bear, and they were ready for the bull run. And so this was the first time that once the on-chain activity ended, that wasn't the end of the bull market like it had been in all the prior instances. We had this other aspect of derivatives and all of the manipulation and the paper claims that can come out of that, and the multiple claims and the way you can manipulate price and expand price from derivatives. That really wasn't around in the same form. And I think it will be there in the future. And so it might create a similar signature, something to think about.
I was going to bring up the perps. I mean, all this stuff existed, but it was, it was all sort of like, a toy in previous cycles. This was the first cycle that we had, like, grown up, liquid, capable perps features, whatever you want to call it, systems. It was the first time that you had, the grown-ups really, like CME in. But, the CME is like you still have like limits on leverage and stuff. You don't go on nowadays, you can go to Binance and go like 100x. And there is liquidity to do that. And another thing that was not available before to the large amounts of Bitcoin was Bitcoin-backed loans. A lot of coin went into these loans, and then it was rehypothecated, right? So it brought in liquidity through the back end in a way that was never available before. Even though these people were not selling, the people borrowing were, right? They were either like whatever the heck they were doing with it, and they were trying a bunch of different stuff. And a lot of times, these coins were just being, going circular, with somebody, kind of like a game of chairs. Somebody was not having them at the right time. And that was part of the reason why we had what we had, right?
It was pretty wild. I mean, I listened to Hugh Hendry had a podcast with Kyle Davies from 3 Arrows Capital, right? And I was listening to this thing, and he was explaining, again, you got to take it with a bowl of salt with that dude, but one thing that I believe it's correct. He was basically saying that as you got into the late stage of the bull, there were lending desks that had to lend. So they went from like, here's some Bitcoin collateral to here's some GBTC collateral.
It's part of the contract.
To the point where they say, okay, we can do it semi-collateralized. And then at the end, he's saying some firm was offering him $600 million uncollateralized because they just had to get the dollars out the door and lend it. That's how insane the market was.
Because it's coming in via clients, is that why?
Yeah, whatever it is, whatever their lending mandate or their remit was, they had to get money out the door, putting it to work.
In traditional finance, this is pretty common.
Well, that's what's so weird. I worked 2 years in public accounting, but that's about it. So like most of my professional experience is within crypto markets. Basically I'm accustomed to, at least, even with Binance and FTX, like their APIs and stuff like that, it's all publicly available data, right? So like the only thing that, on this whole leg down here that nobody caught was all the shit that was going behind closed doors that wasn't showing up in the APIs in the publicly available data. It was just a bunch of insiders who knew it, right? It was basically just a bunch of insiders that blew up the space.
It's not the reserves, it's the liabilities. See, This is why like proof of reserves as we know it, it's kind of stupid because sure, you can sign an address, right? Like,
right.
But one is you don't know if the address is there tomorrow. And two is that what kind of liabilities you have behind that? It could be like 10x liabilities, right? And all these guys are borrowing from each other. It's a tiny market. This is like, people don't understand how small Bitcoin and crypto are.
That's insignificant.
Like, we're kiddie pool of finance, right? Like, the Wall Street boys came in and just, screwed at us for like 10 minutes. You know what I mean?
So like actually that's something that I took away from the bull, and, talking of institutions and traders of all different sizes. One thing that really stood out is the plebs are pretty much into Bitcoin, right? Some people find their tribes, but the vast majority of plebs into Bitcoin. Institutions immediately straight into just give me volatility. I'll trade anything. I don't care what it is. Just give me a price.
Well, not just that, right? They have a chance of dumping. See, this is the game, the new VC game, traditional big VC sort of style, right? A16Z kind of style. So these guys used to have to wait 6 to 10 years to go IPO or second market pre-IPO, right? To dump some of that on the next sort of like, the financiers or retail through the markets, right? But with all these coins, they found a way to dump on retail within like 3 months. So launch a coin and then find liquidity on retail and repeat and just repeat and repeat and repeat and repeat. And and they're going to keep on doing this. We haven't even started. I mean, some guy in some basement at A16 that just invented the next 1000x scam. This is going to be like incredibly insane. And it's inevitable, right? I mean, this is what people need to get burned to understand how to behave in a free market, because there is nobody to pick up the tab.
And that's always true. Every market generation has to learn in like the hardest way possible. It seems, that's what history tells us.
Learning through pain is the only way that, it's like burning your hand. You need a scar.
This is the beauty of why on-chain works, because the human beings are the same. We always respond the exact same way. So whenever, you see analysts drawing lines, trying to match previous cycles, oh, look, it was at this point before. Why? Because that's the point of maximum pain that flushed everyone out, right? That's the amount of endurance that human beings had in every previous cycle. So thus, if human beings are more or less the same, you can start to get these patterns over the long term.
I mean, humans are not going to change.
Absolutely.
That's why, like free markets, for example, I'm like a big, one thing I really love about the Bitcoin community is that it's a big defense wins championships mentality, right? Like you can't thrive unless you survive, right? So
cockroach, you got to survive.
Yeah.
I love that, dude.
Yeah. You have to, you cannot thrive unless you survive, right? So that's why, like, for example, self-custody is a colossal pain in the ass, but you do it so that when FTX rugs, you don't even have to sweat it, right? Like I was just chilling. Like, I mean, it was sad because like I know people who like got, ridiculously fucked on the whole thing. But anything that's inconvenient usually is inconvenient for a reason.
And further to that point, what it's reminded people, even trading firms, they're going to be pulling their profits off exchanges way more regularly now. Once they've done their trading and they'll be using leverage and whatever, but once they've made a buck, they'll be taking it off, which actually creates even more value for on-chain data, because you're seeing these coins coming in and out purely for the safety element.
Yep.
Personal responsibility and self-custody. I think with the problem is we have generations of people that just have not been used to and exposed to this, especially in first world, North America, Western world, right? Like, so Europe. In developed countries, like you just haven't had to deal with these things because the system sort of functioned reasonably okay, and you were just being, frog boiled, right, with inflation through the years. But at the end of the day, I mean, the law still kind of works, and you still kind of stick your ATM machine, your card on the ATM machine, and the money comes out, right? Growing up in Brazil, like, I mean, we had 4 failed currencies in my lifetime, and the government did bail in as well in your savings. So the mentality of people outside of first world sort of like, it's a little bit more like aware of the need of doing these things. They're a little bit more willing to go the extra mile. Plus, I mean, they can't even buy stocks, first because economically is nearly impossible, right? Like a stock is just too expensive a unit. And then, the revolution of stocks happened because you have, somebody else actually owning the stock and you can buy a cut of it. But then like you look in Brazil, like majority of the people own crypto, not stocks. Like, it's crazy.
Totally. I can't remember who it was. Someone put out a post the other day that I responded to, and they were talking about, why would you own stable coins in DeFi at 1% yield when you could just buy a treasury? It's like, because the vast majority of people can't buy treasuries, bro. That's why.
Right. You
Most
can't
people,
buy treasuries.
It is easier for me in Australia to get Bitcoin or gold than US dollars. It's a real pain in the ass for me to get US dollars. And that's what made Luna so absolutely insidious, because it was a stable coin that lots of people who needed a stable coin, a US dollar denominated stable coin during massive inflation, and they got rugged.
Why Luna and not Tether?
Well, that's my favorite thing, is that all these Tether truthers have been looking at Tether as a Ponzi, and there's like an actual Ponzi right next to them, and they keep pointing to this one over here, but that was the one that blew up.
Somebody said it's a wildcat bank. I think I prefer that. If if you want to go to jail in the US, they don't give a crap if you want to be a gold guy or whatever. Now, if you start printing dollars, man, now you got their attention. It is absolutely remarkable that they still are around. I don't know if you guys ever met Phil, like the guy who actually invented Tether. He's an interesting guy.
You have to be.
Yeah.
You know, like it is still to me, like to this day, like amazing what they managed to pull off.
And I have no doubt they did some shady shit back in the day. There's no question. However, where are they currently at? They're in the best possible point in time to be owning treasuries and just earning an enormous amount of money on a shitload of cash sitting in the bank.
It's a money. It prints money on money. Yeah. It's incredible.
I mean, you could also say, right, that like, you know, USG had a conversation with them and said, hey, listen, guys, we're going to let you exist, but you're going to have to be a treasury buyer.
At a time when the US government needs treasury buyers more than anything. It's wild.
Exactly.
Yep.
And who just bought the most treasuries in Q3? Private institutions, which includes hedge funds.
There you go.
So who knows if Tether is in that bucket, but I would imagine they are not in the foreign official bucket.
Circle, which was the sort of like the US approved version of Tether, I believe they also are a buyer of treasuries, right? Like I don't know the size of.
They made 250 million in Q4 or Q3.
That's it.
Well, that's just free float cash for just holding assets. That's just
no, I know,
profit.
but that's tiny. Tether is what, like a couple billion?
Sorry, that's free cash flow they're earning off the treasuries they hold.
Oh, okay.
No, that's revenue.
Yeah, that's a ton.
That's money on top of their reserves.
Beautiful.
Yeah. No. So strangely, actually, I did in our report yesterday. I looked at the dominance of these stablecoins. So Tether through 2022 has been just declining from like 80. I think it was like 90% 2 years ago. It's currently between 45 and 50, but has been stable through 2022. USDC came up and peaked at 38%. And ironically enough, its dominance tried to climb after Luna, but it's now declined back to like 20 or 28% or something. And BUSD is on the rise. BUSD is the big winner for the year.
Well, it all started when CZ disabled USDC pairs trading on Binance. And it's actually really funny. I think the head of Circle came out and said, this is not a big deal. Like, don't worry about it. Like, this will be good for USDC in the long term. And ever since then, the chart is just completely down and to the right.
Down.
So just for reference, right? How big is the total issuance of Tether? How big is the Binance dollar, and how much is Circle?
The peak of everything. Hang on.
I'm pulling it as well. Just taking a second.
We've literally just spent all of Q4 rolling out these very charts.
You guys are missing out seeing the faces of this chart people, like all now concentrated in getting numbers.
Total stablecoin cap right now is 136 billion off a peak of 160. Tether is 65, USDC 42, BUSD 22.
Yep.
The BUSD is about half the size of Circle.
So the Circle thing, I know that a lot of lenders, like Bitcoin-backed lenders in North America, they kind of only do Circle now, USDC, because I think it's part of the compliance thing. So essentially what's happening in the market is, like, you know, you have the state-approved way of behaving in the space, and that includes the state-approved stablecoin, right?
They'll be geographically dispersed. You'll
Yes.
see Asia has been a large buyer of Tether for a long time. USDC, US.
Makes sense.
Mm-hmm.
So how does a hedge fund behave in this environment, Permabull? How do you guys navigate this stuff using some quality chain analytics?
Well, what's funny enough is that we've been basically in cash and self-custodying the cash all year.
That's everybody now.
Yeah. So like basically we are like effectively been an anomaly in the market, and that's been the way to play it. And generally speaking, we were pretty, bearish up until the fee market started waking up around 20K. And then we were like, all right, well, now it's time to start looking at taking some stabs on stuff, maybe dive back into some yield. But the problem is, as you've seen, and we discussed earlier on the podcast, a lot of yield opportunities have gotten a lot more difficult to come around all across DeFi as well, right? So generally speaking, we have been very, very conservative, and just, people say this a lot, in bull markets, you FOMO, in bear markets, you're patient, right? So, we're still at the depths of the bear market and we're just taking our time waiting to deploy cash. But, generally speaking, self-custodying in cash has basically been the way to play it.
How do you guys do like basic due diligence on some of the yield opportunities that you're seeking? I imagine a lot of those are based on DeFi smart contracts and things like that. How do you guys assess, the risk of rug pull?
Well, I mean, keep in mind that we have Solidity devs that we have on hand that do a lot of like the contract assessment. Like, for example, I am just measly like an API monkey, right? Like I am just like a Python coder. You know what I'm saying? Check is a much better Python coder than I am. He's actually the one who taught me how to code Python. But generally speaking, we have the Solidity devs go in and check and make sure the contracts are all good. These are from trusted sources. And also we have our own risk parameters in terms of how much we're willing to put into a single position or smart contract, right? Because we're like, you don't want to put in like over a certain threshold of the fund into one contract, then it gets exploited. And then you have to go back to your LPs and be like, hey, we just bet the farm on this one thing and it's gone.
Right. Do you guys have any stuff, like any coins stuck on staking? For example, were you guys aware that you wouldn't be able to withdraw if you are there? You don't have to answer if this is sort of like, I'm just curious.
In terms of stuff being stuck? What do you mean stuck though?
So you can't withdraw, right, from staking positions on Ethereum.
Oh yeah. No, we've maintained liquidity. Basically, we didn't overcommit to anything. We're very careful about in terms of like how much money we're going to deploy. Especially once we've seen so many people blow up over time, we're making sure that
Spacewell has been around a while, right?
Yeah. It's been around for a hot minute. So we've got two funds, but most of our our active management is within Fund 2. But yeah, we're very careful. And, now that we've seen everybody blow up, we're still at the depths of the bear. I think the main goal right now, if you're a fund and you didn't get completely clipped, right, is to make sure that you live to see the fun times again, right? You're not trying to like risk it all and be like, get that YOLO long or that YOLO yield when things are so uncertain, right? You basically have to increase that percentage chance that something goes wrong at these points in time.
So as a fund, when you guys are in cash, and I'm just curious, like, does that mean you guys are in stables? Like, are people sitting in stable coins, or have they left the market and are actually in cash / like treasuries types of things? What are funds usually doing? And then I guess my second question would be, has seeing like the blow up of like Ikigai and the loss that Galloy Capital had, like, does that change any of you guys like thoughts about where you sit your positions and how much you custody of your like active holdings or whatever, like, has that changed your calculus at all?
Like, I'm not going to go into like too much detail, but we basically are like I said before, with a lot of our other stuff, we make sure that we're not like, it's same thing as like going into like a DeFi yield strategy or something like that. You have to make sure that you're not going to blow up if something goes wrong in one place, right? And that is how we go about managing our risk, if that makes sense. That's probably the most detail I can provide when it comes to that. But
no, like it comes back, and I think part of what you were saying, TX, is there's a risk in stablecoins even. So I made a decision because I had a bunch of stablecoins, I don't know, back in the 20K range, somewhere in there. And I was just looking at the whole scenario, and this is pre-FTX, but post 3 Arrows and all the rest of it. I was like, man, I just feel like there's going to be some kind of crackdown on Tether, and these things have counterparty risk, right? And I just made the calls like, all right, a Bitcoin is essentially my stablecoin now. And from that point in time, I was like, there's no stablecoins. I'm just going to go, it's either Bitcoin in or out.
You're not the first one I hear this from, Checkmate. I have some good friends who have some very interesting positions who sort of said, hey, do you know anybody who's seeking investments? Because these are people who already have enough positions in Bitcoin, even though you can never have enough Bitcoin. So, but they were looking, to have some funds in, USD like things, right? Most of them took their funds out of stable coins, and they were like, I'd just rather buy stakes in companies and, real estate or whatever else. Because you also can't go to the markets right now, right? Like, I mean, we're still looking at a possible like macro meltdown in the spring. So like, there is no place of safe refuge right now unless you are a hedge fund, right? Like, and you have the resources and the liquidity and, expertise to sort of like really hedge a lot of different sort of scenarios. So, most independent investors and things like that are really trying to just sort of find refuge, right? And, Bitcoin has proved that, if you stay long enough, you will find at least a few X from your previous position. And that's been true so far for over 10 years, right? So just sort of like switching up a little, where do you guys see the potential for, say, for example, state actors and to use the same sort of tools that we are using to, some people are using to trade, some people are using to calculate new technology and how to do it. Are you guys seeing like a lot of state actors take advantage of on-chain analysis, aside from the stupid chain analysis for like, are you 2 hops or 3 hops from Silk Road kind of thing? No, I'm talking about sort of like a more sophisticated sort of like way of like taking advantage of this data that is public, if it is to like attack institutions economically, to, measure their opponents, or, try to apply sanctions and that kind of stuff.
Yeah, I think that there's kind of 2 answers to that. One is there's no question that there's institutions, regulators, banks that are using this, for their own understanding and education. And they come in various forms. Like there's a lot of institutions who are like retail level of understanding of how this stuff works, right? Very, very rudimentary, still trying to learn what a metric is, right? How do these things actually tick over? What's the information mean? There's other institutions, and some of them that surprised me actually, who were very, very adept. They understood what a coin day destruction was. They understood liveliness, all sorts of metrics.
What kind of institution was that?
I can't say, but
no, just a category.
Yeah, very, very large, very, very large and important banks.
Okay.
Understood. But there's also been very, very large and important banks that have absolutely no idea. So, they're saying, give me the starting pack. And then there's others who are asking very fine details about, I need to understand, some of the entity adjusted type things because I already understand all these metrics. Our analysts have been studying this thing for 2 or 3 years. So there is a massive bifurcation across both retail and institutions, because retail has had years to study this thing. Some people did, some people didn't. Institutions have had the same, but there's this massive bifurcation. But also there's a competitive edge. If you're an exchange and you want to know what your competitor is doing, this is CZ, there's no question that CZ had a bunch of analysts trying to work out what was going on with FTX, right? Part of his decision framework had a lot to do with him understanding what was going on chain on their wallets. And I've said this on, I think it was this podcast before. When we go back and, everyone's got hindsight bias, but we always found that FTX had the most complex wallet heuristics. And now you start hearing people saying we could never find their cold wallets. It's like
there wasn't a cold wallet.
there actually wasn't a cold wallet. That's the wild thing about it. So like people thought that because they had these long, complex peeling chains.
I remember when we were trying to get them their exchange balance, it took those Glassnode guys took them forever.
And they were consistent. Every time we got it, they would change it. Their heuristics were always evolving. And now
they created all this transfer volume. There was all this noise on the ledger just specifically from them. It was crazy.
Correct. There was 2 entities that created a shitload. And this is where it comes down to the adjusting, right? If you just look at transfer volume on the blockchain, there was actually one entity that was using almost all of the transfer volume. And it wasn't FTX. It was REN BTC. So Dave Puel and I were digging around going, I don't understand why transfer volume is so massive. And then you do change adjustment, which removes, like you can do wallet heuristics and remove the change. Change adjusted was just massively smaller. And then entity adjusted was even smaller than that. And we're talking like 70% of all volume. And what was going on is REN BTC, it's one of these like pegged stablecoins, pegged Bitcoin on Ethereum. And what they did is they had at the peak, 36,000 BTC. And every time someone deposited 0.01 or withdrew 0.02, the whole chain would spend. So it's moving 36,000 BTC once every 5 or 6 blocks every single day. The whole time. So it's just this enormous chunk of change just moving around.
Seems so inefficient.
Well, it isn't, because all you're doing is moving your whole balance. You're just spending the Bitcoin transaction fee, the marginal transaction fee. So it's actually not inefficient, because on a per UTXO level, it's one UTXO, not thousands. Imagine CZ when he's got to consolidate all those wallets. That's a pain in the ass.
Coinbase, I think was probably 2017 or 2014? I think 2017. They had quite a few $1 million stuck in dust.
That's why they pushed for SegWit 2x, right?
Because they were not batching the UTXOs, and it was just economically unspendable until the price went up. I guess number go up fixes everything, right?
As far as the state, I'd like to comment on the state actor thing a little bit. I think that it's certainly possible, and Check would be in a better position than me to know nowadays, obviously, institutions and how interested and how knowledgeable they are. But just thinking about the way the ledger could be used in the future, if it's settling extremely large economic activity as a base layer mechanism for like a reserve asset in this, scenario we're talking about here, where state level entities are using Bitcoin. I think that those things could also be obfuscated a lot. Like the ledger itself then becomes a playing field. And so the information you're putting on there is just as useful as the information you're trying to extract. And so I think that that those things don't happen in a vacuum. And when you think about just like what we have today, entities like Fireblocks that represent almost like a commercial bill of credit system on Bitcoin, where they have credit lines set up with like, in, for example, Coinbase custody or whomever else, and they can settle transactions between clients because of their credit lines, and all that really ends up on chain is the P&L difference between the two entities. And Charles Edwards has written about this.
It's just like how banks work.
Yeah, it's how banks work. That's how commercial bills of credit worked hundreds of years ago in Europe, thousands of years ago in China. Like, this is not a new system. And I think that is a very plausible scenario in the future where maybe there's central clearinghouses of the Fireblocks ilk, but maybe not them. Maybe it's something else. But they represent a lot of economic activity within their black box, not dissimilar to the way exchanges do for retail today. And we only end up seeing kind of the FUs, that comes off, the P&L that comes off. And so those things could get masked. And that's another reason why I think it's so important to have nuance about on-chain, to understand that you're looking at aggregates and you're making inferences about behavior and things that are happening at a time and place and time. And so they can be very accurate, but there are also nuances to it and ways it could be manipulated that you kind of always have to factor in.
And actually, even further to that, there's the old faithful whale alert bot on Twitter, right? Which is complete.
That account.
It's complete shit. If you follow it,
total shit.
Unfollow it because it's just rubbish.
I love that account. It's hilarious.
But more importantly, no, it's horrible. But what it does do, if you're a whale, what these whales are doing. So since FTX, whales are the only cohort, and we talk about whales 1,000 BTC plus. They're the only ones who have not been growing their balance. Right? Everyone else has been sucking coins off. So what are you saying? Like whales were just like prepared for this thing? The answer is no. What you're seeing is that the cohorts below them, the 100s and the 10 BTC, that kind of grouping, they are seeing an enormous push higher. And what whales are doing is that they don't want to have a 1,000 BTC UTXO because when they go to spend it, the whole market gets a tweet.
Right. They're breaking them down.
They're breaking them down. They know exactly what's going on. They're breaking them down.
One way you can do this is by manipulating the market, right? So you make a massive transaction, right? People think you're actually sending to sell, right? They start dumping so you can buy. Like
you're actually splitting.
These things used to be the norm before the market was more sophisticated, right? Like in the Mt. Gox days, you could make 5% every day, just buy in the morning, sell in the afternoon. Like, there were like stupid things like this. Like you're just waiting for the market to open somewhere else and you could just do like very basic arbitrage. These things won't change, but they're definitely becoming more sophisticated. I imagine, like these exchanges will start doing some coin join really in one way or another. I imagine it's in their interest to start hiding a lot of their movement like FTX was. Are you guys seeing other exchanges increase their sort of like finding an edge in privacy, right? Because as a financial institution, I mean, like people not knowing what you're doing and how much you have, it's like one of the best edges you have. So like, are you guys actually seeing it happen on chain with more exchanges, this kind of like cloaking of their funds and moves?
I've not seen it, nor have I heard about it from our guys yet. We do have a bunch of CoinJoin metrics on our internal site, which I'm going to have a look at as we speak. So let me have a poke around. But so far, I've not seen or heard anything of that regard. For the most part, so probably the only analog to that is that there's lots of people yelling about Binance at the moment. Binance has got one of the most transparent sets of wallets. They're actually remarkably easy. They don't appear to try and obfuscate anything. Which take that as information, do with it what you will. But there's a lot of people saying that Binance has no coins. I'm like, well, they got a shitload of Bitcoin for someone who's insolvent.
Yeah, like with FTX, you could see their Bitcoin coming off their exchange for the last many months, and it's just the opposite is happening for Binance.
Binance is a tricky thing, right? I mean, like their pile, like their size is so big now that even if you find a lot of coins, it's probably not enough to cover. And God knows there are other liabilities, what kind of other shitcoins they're involved in, and what kind of like exchange tokens that are not the ones we know about, they're a huge part of. It's very hard to measure exposure, right? Because these are like traditionally, when you have entities this big, they're all public companies. So there's a different kind of transparency level, right? I mean, like, listen, Enron happened, right? So you can always buy the accountants too. But there is a certain level of reporting, a certain level of due diligence that happens. In this space, you have these actors now that are ginormous. And there is zero transparency on liabilities. The on-chain stuff is there, or kind of there. But their liabilities, again, like you can't quantify real estate in the blockchain. Actually, how do you guys account for some of this stuff when you're making your analysis? Like, how do you try to discount liabilities that are not on chain?
So, when you think about it though, right, like you see a certain amount of reserves that they have, just purely from an accounting standpoint, right? It's assets minus liabilities equals equity. So like, even if it's not the full picture, like if they have a media amount of coins that you're looking at, like it's still a material size of what the actual equity is of the company, right? And another thing that I find interesting about Binance in terms of, signal, right, quote unquote signal that they are solvent, that they have money, is that before FTX went down, as a strategic move, which I think was designed to screw over FTX, they made their Bitcoin and ETH spot trading free, right? They made it feeless. And that's why the second that happened, I tracked the number of trades that happens for those pairs on Binance, it skyrocketed, right? Because nobody has to pay fees to trade coins anymore, right? That basically volume has completely lost signal on those trading pairs, right? Because it's free. It's like the same things like spam prevention for Bitcoin fees on chain.
Maybe they're running their own bots like Gox did.
Well, it doesn't really matter, I guess, that much though, right? I'm just talking about in terms of it being a signal that if they can afford to give up fees on their most liquid pairs by far, and when I say they're the most liquid pairs, if you look even at the open interest on like the BTC and ETH perps on Binance, they are orders of magnitude larger. It's basically BTC, ETH, and BNB, and then everything else in terms of liquidity on the exchange.
Well, I mean, Binance has what, like $40 billion right now in Bitcoin or Bitcoin, whatever. I don't even know, like when they say we have this in Bitcoin, I don't believe that is actually Bitcoin spot, right? Like, I think it's whatever calculation of their claim of how much Bitcoin would be liquid on spot kind of thing versus the other exchanges.
Do you not believe their exchange balance?
I really don't.
So this is the other thing. So we've got two types of metrics on Glassnode. We just rolled out our proof of reserve metrics. Now they're different to exchange balances because, exchange balances is our best estimate based on all our heuristics. Mm-hmm. Proof of reserves is CZ saying these are the wallets, right? Now, when you overlay them, you want proof of reserves, and then you always want exchange balances to be sitting just above it, right? Because means that's all the new deposits, stuff that hasn't been accounted for. And Binance is pretty clean. When you compare the two, they're pretty clean. And in fact, most exchanges are pretty clean that have done proof of reserves to a higher degree, which goes two ways, right? It's basically saying that they appear to be showing us what should be there. And also Glassnode's, because we've done exchange balances a lot longer than proof of reserves, the tools that we've done have been pretty good at actually tracking these things.
So if I'm looking at whatever, like what's the volume for Binance right now? 30 billion, something like that in Bitcoin for Bitcoin USD?
Let's have a look. So proof of reserves, Binance saying, so in their wallets that they've disclosed, 424,000 BTC. And in our best estimate, 652.
Okay. And then like you go look at Coinbase or Kraken or whatever, like, I mean, those guys are going to have like at least 2 orders of magnitude less, right?
So Coinbase is actually quite an interesting one. So Because they're a publicly listed company, they have to actually tell the market with announcements how much they've got. Now, Coinbase also hasn't done a proof of reserves, and they also custody GBTC and many others. And TX, you and I have talked about this.
I'm glad you're bringing this up.
Yeah, there's a big stair-stepping pattern going on with Coinbase. Now, this is a really interesting problem because what we're seeing look like withdrawals. Now, when you see those big whale cost averaging stair steps, a huge chunk of it's going to Grayscale. They won't report Grayscale's wallets for, what do they say, security reasons or whatever. But the highest probably, and then they announce on their public statements, which you would presume Brian Armstrong's not going to lie to the SEC, that they've got 2 million BTC. So our exchange balances declined from 1 million to 500,000 at a time when they're now saying that they have 2 million. So what that means is that there's a Coinbase custody entity in this whole mix, and probably several other custody solutions. But the coins basically get pulled out of Coinbase. They leave the Coinbase cluster, but then they never interact with another cluster, or they just stay unspent. So what's happening is that these coins, you can't discern that they're not a withdrawal because they look exactly like a withdrawal and you can't pick them apart.
Well, technically they are, right? Because the trusts normally take custody of those purchases. So
they're not available on Coinbase's order.
No, but legally they are not even Coinbase's anymore, right? Like they go into a different ownership structure
Correct.
as well. I think MicroStrategy is custody at Coinbase, if I remember right.
And that's the thing. So when you see these exchange balances going down, they may still be on Coinbase, but they're not on Coinbase. So this is the nuance.
What about volume? So say, for example, Binance right now is what, 3.8 billion in volume, and say Kraken is 31 million. So I guess that reflects the lack of fees, right? I mean, like no fees, everybody goes there. And also you can do things in Binance that you can't in the other exchanges, right? Because they're just not allowed to do it. It really is that simple.
Coinbase, they acquired that. There was that other custodian in 2019 they acquired, Zappo, X-A-P-O.
Yep.
I've wondered as I've talked to Check about this Coinbase thing, because their exchange balance, the reason I brought this up with him and we talked about it originally is because Coinbase, oddly, amongst all the exchanges that we track, like he said, it's a stair step and it's the only one that looks like that. All the others have a much more random kind of movement. And I've been wondering if maybe like whatever they acquired from that Zappo organization, maybe that's some kind of a cluster that they've been continuing to use and they're withdrawing to.
So Zappo started out by Wences, forgot his last name.
Caceres.
That company was essentially like a payments company to start, and then they saw an opening to become a custodian because nobody could custody at that time, like really large amounts. And they had a whole marketing pitch about being in a mine in Switzerland and blah, blah, blah.
Right in the mountains.
So there is a lot of old large piles there, right? And they essentially incorporated that into their balance sheet. I imagine a lot of that never moved. It literally didn't move on chain. So maybe there is a relationship with some of that being now. I wouldn't call it rehypothecated, but maybe it's just moving between new corporate structures of the same owner, but they have to have a signature on chain or something like that. Anyways, it's interesting. Like, Tether truthers and the Tether FUD will never go away, but it's also impossible for us to know if it's true or not.
Yeah.
And the exchanges, again, same problem. Do we find a path forward where people who have to have funds at risk, right? So you have to have it there because you're trading, because you're landing, or whatever it is that you're doing. Is there a safer path forward for the customers or the institutional customers where they would be able to sort of find better heuristics to know, aside from just believing a certificate signed by one of the big four accounting firms?
I mean, aside from a proper proof of reserves, and like proof of reserves requires liabilities as well, right? It's a two-sided equation, and some exchanges will do it. So this thing, I guess, it comes down to, will proof of reserves actually stand the test of time? Because this is not the first time this has been like a hot topic issue. Proof of reserves has come up many, many times.
I mean, we had Ver attesting to the bank account of, if you guys were around for that, that was a lot of fun. I do believe the funds are in the bank account.
Oh, actually, I think I've seen the videos of that. Yeah.
Oh, it's priceless.
Yeah. So look, the answer is that there kind of is there is no other solution aside from self-custody to know that they're definitely there. Some entities will do better proof of reserves. I also think we will probably see in this whole regulatory push that's coming, they might mandate proof of reserves and audits, or they may just go down the other path of just saying no more self-custody, and it has to be with and separating exchange from custodian.
But regulation doesn't matter. I mean, funds will just go abroad. I mean, that's what happened with Binance, right?
Oh,
I mean,
totally. But they don't think about that.
You know, they put a bunch of regulation on Coinbase and make Coinbase do all this stuff. Like, people are just like, screw it, I'm just going to go to Binance, right? And there's always going to be another place for you to go, you know, throw the dice, right?
So one thing that I have been thinking about is that there's a possibility or even a probability that they'll start moving towards separating exchange and custodian. So if you are Binance, maybe Binance is probably an exception, but if you are Coinbase custody needs to be a separate Chinese firewalled entity.
Glass-Steagall.
And yeah, exactly. Separate these things out. Now, what that will probably do is that there will be a handful of BitGos and Prime Trusts, and you will actually get an even further concentration of coin holdings, which proof of work, not so much of a problem. Elsewhere, huge problem.
Yeah, no, it's the biggest fear with concentration of coins and is you do start to run into inflation problems, right? Even in Bitcoin. You know, if 80% of Bitcoin is custodial, I mean, like, it's not hard to print Bitcoin and just never get called on spot, right? Because it's just the majority is opaque. That's really the problem that gold had, right? Gold died because of that. It's just not available. It's in somebody else's safe, so you don't know, right? And we had run into some of this with Bitcoin, right? I mean, we don't have a spot ETF, so you can't call their bet in the traditional markets.
Are you saying that you're worried from like a fees perspective on chain to like maintain like security of the network moving forward, that coins aren't moving?
I'm not a subscriber to a security budget or any concern around that. I think people misunderstand how much money miners make already, and how they hedge themselves to the next cycle.
I think that was massively underappreciated this bull too. That miners sold their coins months ago much higher. And they're only delivering them now.
What people don't understand is how profitable they are. I mean, like, some of people only watch the new players that have great marketing talk about their crap, and they have absolutely no idea what they're doing. You see some of the old guys who have massive mining operations, some of them who did get gobbled up by some public players. But like, these guys were mining, like they were making like $3,000-$4,000 coins when Bitcoin was $60,000, right? And they're not idiots, right? They were selling to capture some of that because they knew that, you know, the drop's going to come. I mean, some of these miners have been around, maybe not under the same sort of structure, you know, for like 3, 4, 5 cycles, right? People do a lot better than people think. So like the miners understand this, and the fee problem you're not going to resolve with, you know, 1% inflation is not going to do that. The market is just going to sort of, you know, price that in, and then you're just back into square one. That's why we have fiat.
I think one thing that's underappreciated a lot that people just for some reason like to completely browse over is the fact that SegWit happened. Like, if you look at the average block size for Bitcoin, it's still up and to the right? Like, in the average block size is right around what would have been a full block with pre-SegWit. So if you're like, oh, you know, like over time, you know, can it maintain its security budget? It's like, dude, I remember in 2016, 2017, you'd have Roger Ver just screaming all over Twitter about how it was so expensive to use Bitcoin, right?
And it was all Coinbase's fault. Like,
oh, just from like bad UTXO management?
Yeah. I mean, they were a huge part of it. And because of their fees, it was economically viable for them, right? To do what they were doing. There is no wrong, unaccepted way of using the block space is simply a vassal for a market, right? How it gets fueled is none of my business, right? If you have a business model that allows you to 10x overpay for that space because inefficiency, but whatever, right? For you just makes sense, but by all means, you know, like, you get it, right? And we did increase the block size by a lot with SegWit, right? It's technically 4 megabytes now, so completely unnecessary. But the point is, we don't need a security budget. I think the market will find a way. Miners are extremely profitable. We are overly secured anyways.
And also, I think a lot of people forget that the block subsidy is a subsidy to build out the infrastructure, right? These ASICs last a lot longer. S9s are still chugging away somewhere in the world. So it builds out the initial infrastructure. And then if the subsidy, because this is what Eric Voskuil does really good, when he explains that the subsidy goes to the attacker as well. In a 51% attack, they get it as well. So the subsidy is actually not what provides the security, the fees are.
I don't like the word subsidy. I prefer to think as a fixed fair schedule of distribution of the original final supply, right? So
it does roll off the tongue as well, though.
So I know, but we have a predictable, fair distribution schedule, right, for a finite supply asset, right? You need a way of fairly distributing this if you want players to come into this market, right? And even if it's unfair, it's still predictable and it is fixed. So like
it is a schedule.
Right? So it's not inflation. Inflation is the wrong way of looking at this. That's the fiat disease, right? But it's also not subsidy because technically, you know, the people who have number go up for other reasons, right, are getting a subsidy for being this network, which is not really a subsidy. It's just getting rich because they are in this network taking risk early. You know, it's just you had to find a way of distributing it. And this was a clever way of doing it. It's very clear, very transparent. So, you know, it's not like, you know, Zcash where, you know, Zuko gets 30%. You know, like you don't have this kind of stuff, right? So you have this immaculate conception, you have this fair distribution, it works, it's clear. If people see the need to secure the network because in their view it's not secured enough, well, they're going to pay for it, but they're going to pay it themselves, right? This is not communism. We don't have to force each other to pay just because we believe on something. But anyways, that's just a little tangent there on that.
And it's also not a subsidy because you still have to work for it, because if you don't work for it, someone else will.
It's bootstrapping capital. It's like giving somebody sweat equity in a startup to some extent, right? Like you have to incentivize people to contribute their labor and time to, you know, the enterprise, basically, right?
It's just the cost of capital.
Yeah.
The fight over the reward is the cost of capital. That's what makes it so good.
Yeah, I mean, like, I've been around this like since Bitcoin was very cheap, right? Back in those days, I mean, like, none of us thought this thing was going to be what it is now. I mean, there was none of this like perfect narrative and understanding of economics and hyper-Bitcoinization and this shit. Like, back then, it was just like, look at my cool internet money. Like, you know, and people spent it, right? People wanted to build businesses. And that's why there's very few people who like sort of like really capped a pile from back in the day. I mean, it gets redistributed, and you can see this on chain.
For sure.
You can see it on chain. I mean, if you look at how much of the supply moved over 2 years ago, it was 45%, which means that in this bull run, more than half of the circulating supply was churned in some regard. Like between now and December of 2020.
100%. When you look at, so we've been playing around with like, how do you adjust for lost coins? Because I don't really care that Satoshi's in profit. Good for you. What I don't want is Satoshi's profit to be like all these lost coins to be skewing the results, right? You've got this massive profit multiple. Well, if you remove coins that are older than 7 years, there's something like less than 20% of the supply. And this is like all supply is in profit. So the vast majority of pretty much every Bitcoin that's going to move has moved and is underwater.
So just knowing the amount of friends and people I knew back then, this is before hierarchical deterministic wallets, before BIP39, before all the stuff that makes you not lose money. People used to just get locked out of their Bitcoin core on a laptop. It's just an insane amount of people. And then when Armory came around, a lot of people got locked out of Armory because it was so secure and complicated. You know, I used to have this rule of thumb that, like, you know, my belief was that a good 20% of all the coins are lost forever. Does this ring any true to your guys' analytics?
Yeah, no, absolutely. I'm of the conviction that at least like 6 to 7 million could be lost. And the way to look at it, and I think TX, you did a really good paper on this. When the price gets back to the previous all-time high, that's when you start seeing old hands start spending. And the logic is, let's take, you know, lost coins from back in the early days. If they've gone through the 2013 peaks, they've gone through the 2017 peak, and they've gone through this peak and they still didn't spend, at the absolute height of the market, you have the maximum amount of spending. So
No, somebody has to feed.
exactly.
Right? Somebody has to be selling, right?
Exactly.
At those peaks.
Someone is selling every time.
Yeah, you start seeing the troughs of all these old coins at the market high.
And it's not the guy from the previous peak seeking, 3-4x.
Yeah, so check. You're basically saying if they're not spending them then they're that much higher probability that they're lost, because that would be the time to do it.
Exactly. When you start looking at coins from an age band perspective and you look at it at market cycle highs, you start to see this almost logarithmic curve that's flattening out quite significantly around that 6 to 7 million coin mark. These are coins that simply have not been spent at the point of maximum incentive multiple times, thus highly likely to be lost.
Would you say, I guess like you could almost see this in the same way. So you have a lot of OGs now not selling, right? What they do is they go get a Bitcoin back loan.
Mm-hmm.
But that's still coins days destroyed. So you're going to have coins that are old, right, being moved at, around, when the peak starts to go up, like, okay, I want to buy a house or whatever it's going to be. I don't want to sell Bitcoin. I have the conviction. I'm not into, perps or whatever, so the person goes and deposits, like moves this very old wallet into a lender, right? And I guess you would be able to see that as if it was a sale, right? Is that how it would look like on analytics?
Well, it doesn't have to be a sale. What it means, and it depends what your analysis scope is, right? You may see them go into, let's run the clock forward, right? We've now got Fidelity as an entity that we track. They've transferred it into Fidelity custody. You can presume, well, they've got this many coins, they may not be sold. But what you are seeing is that they're not dead, right? Those coins are not lost. So it kind of comes down to what the frame of reference you're looking at it from.
Okay. So I have a few questions here from like some people on Twitter for this episode. It would be awesome if they could break down market dominance, BTC versus ETH, from other metrics like realized cap rather than total market cap, and how they see on-chain analysis becoming macroeconomists of the future as Bitcoin becomes the world reserve asset. This is by Fabio7.
Oh, Fabio. He's my favorite Glassnode member. I've met him before. He we did a bunch of user interviews, and Fabio was one of the guys that came on. So Fabio, if you're listening, mate, you're a hero. So this is a great question. I put out that tweet the other day about realized dominance, right? Realized dominance is trying to, because we know that market cap dominance is bullshit for several reasons. Market cap doesn't make sense. FTT, great example. They inflated the price of FTT. They can print extra tokens, market cap goes up, but there's not enough buyers for that. So it doesn't account for liquidity. It overestimates, Satoshi's coins should not be valued at the current spot price, because if he sold them, we're going much lower.
What's your discount rate for old coins not moving? So like essentially like, let's call it time since possible death, right?
So that grading curve, there's two groupings I would put to that. That's why we use long-term, short-term holder, right? That concept, it's very memeable, long-term holders, but there's actually science behind it. When you get a coin that's older than 5 months, the probability of it being spent collapses down to less than 1%. And it's pretty stable through the rest of history, right? It keeps decaying, but in logarithmic space. So essentially, once you pass 5 months, the probability of you spending is much, much lower. There's a second boundary beyond that, which is about 3 years, somewhere in that realm, where once you get past 3 years, you've essentially seen enough volatility and chaos that that's kind of the cycle, right? Within that 3 year period, someone's going to spend, you're going to UTXO manage, you'll move it to a custodian, you'll do something with your coins. Once you get beyond then, the probability that you're actually a lost coin continues to go up and up and up. So in terms of how you discount it, it depends what kind of models you're trying to run. There are tools out there you can use. This is actually something that Dave Pule and I have been working on. Hopefully it'll be out soon, but an actual model to do exactly this, properly discount lost coins and then try and adjust everything else that's going on, because we've got all these metrics and some of them will drift, but you do have to correct for lost coins, and a bit of a methodology on how we can do that.
I find a lot of amuse. People don't understand that Satoshi can't spend the Genesis block coins. There's like a bug and you can't move them. So those are gone
So that's only 50 BTC, right?
Yeah. And the fascinating thing is they also don't understand that Satoshi could have been kept on mining after in there any NIMs and probably
Spun
did.
up any number of other machines.
You'd be very silly to actually mine and also tell everybody that he mined under different names, or it's just all so silly.
Sorry, getting back to Fabio's question.
Yes.
So on dominance, market cap dominance, it doesn't account for liquidity. It overinflates token supplies. And what it does do is it allows Ripple to print, the whole supply and then value them at the market and say, look how dominant we are. If you do something like realized cap dominance, so realized cap calculates each coin at the price when it last moved. So all of Ripple's coins that they've minted for themselves but haven't spent them, they can't be valued. You could also, in theory, you could discount out founder coins. So what that does, when you run market cap dominance, Bitcoin dominance is like 40%, right? And is trending sideways for a long time. If you look at realized cap dominance, Bitcoin is now back up to 60%. It's been in a multi-year rising pattern since 2017. And that's because you're essentially removing all of the coin, the FTTs that just don't deserve that market cap. When shitcoins go down their minus 99% price route, all the people who start spending are revaluing their top coins down to cents. And that essentially shows this like long tail destruction of realized cap.
So the flipping is not going to happen.
Well, not quite, because the result that you end up when you actually run that study is that it's BTC and ETH are the only two assets that have maintained a significant realized cap. So as much as Bitcoin is want to push back on ETH, it's the only one that's actually got a sizable realized cap that has maintained itself over several years.
Well, I mean, like you can think of ETH as a high volume thing, right? Because they're trying to build like refinancialization of everything, right? So if you move the pie around enough, you're just going to keep on getting a higher volume and higher cap. Like there is no way around it. So that's why I personally find a terrible way of looking at it. So quick thing. So Perma has to leave in about 10, 15 minutes. Any topics, sir, you wanna bring on before you start sort of like wrapping up and maybe drop off?
No, top of mind, not really. I'm just curious. I guess maybe one thing that I'm curious in terms of what the room thinks. What are we thinking in terms of market outlook over the next 6 months?
Personally, I'm just waiting for another shoe to drop or we go sideways. There is not going to be up for a while. There's not going to be the Christmas up.
I concur with that. The underlying dynamics of the market outside of Bitcoin entirely has fundamentally changed from the way it has been throughout Bitcoin's life. And it could conceivably be this way throughout at least maybe this next year. It could be tough conditions. So I personally don't think that the low of price is in, but that doesn't mean we have to go straight down. I think a crab market is probably the least expected and most painful thing we could deal with. And we could certainly continue to range. We could have rallies, we could have crashes. But I think that the low probably won't be in until, maybe the second quarter or third quarter of next year. And then maybe things could possibly start looking more constructive. But we haven't seen a real capitulation in TradFi. And that is probably what's going to be the bottom of the broad bear market. So I think Bitcoin kind of has to wait for that, unfortunately.
So we're essentially on the grind, right? Now, here's the interesting thing, right? Bitcoin, because it's so small, right, often responds to whichever is the new interested big pocket in Bitcoin, right? So previously was private investors, VCs, right? That was the 2017 cycle. Before that was technology people that wanted to do payments. This cycle was the equity guys, right? There were a lot of equity guys that came in. That's why they were trading Bitcoin like equity. That's why Bitcoin traded like an equity, right? So what's the next pocket? Because the equity guys are getting burned and they're going to get poor. Realistically speaking, if the Fed doesn't pivot in some amazing way soon, they're all going to be having fun staying poor. So like, who's the next pocket?
It's a good question, but when I look at like the overall spread of what's going on right now, and just to kind of bring it back to the previous point. So the last time, Rodolfo, we did this podcast, price was selling off down to 15.5. And we all said, is this the bottom? And I think I said yes. So I'm going to have to just maintain that called the bottom on the actual bottom.
Respect.
When I look at transfer volume and whale activity and all these things, I can't help but feel that we have a textbook layout. Every bottom has looked exactly like this, but the big money appears to be massively underallocated to it. And I've been describing this like, if your bond portfolio is selling off, you don't go digging around for couch cushions, right? Bitcoin is so small. If you needed the money from Bitcoin to save your bond portfolio, you've sold it. You are so out.
I mean, everybody's short Bitcoin. That meme is always true.
I think that there is an under ownership problem in here as well. And also Bitcoin tends to be the first thing to sniff out some kind of change. I agree, TX, that the world's in for an absolute shitstorm. It's not good, right? Macro looks absolutely horrific. The question is, does the market sniff out that the Fed has to reverse course because of how bad it is? And it's thus potentially probably crabbing, and also not all-time highing anytime soon. But do we actually start to get that underbid when the market starts to realize that this is an unsustainable recession that's coming, and they're going to have to reverse course, or their hand's going to get forced at some point, right? The Luke Groman moment.
Yeah, I think that's possible.
Here's a fun common question here is being Bitcoin believers, let's call it this way. We know this is protection versus, traditional finance, right? But when the inevitable next real bad crash happens in traditional markets, does it see Bitcoin's safety before or after it happens, right? Because see, if it's after everybody's poor and they can't buy Bitcoin and Bitcoin dives with it. So do we see Bitcoin pumping inversely correlated, or does it go down with it?
Goes down with it.
Yeah, if it's that bad, then I would be shocked if people were super bid on Bitcoin when that's going on. But I don't know. Part of me always just wonders if like effectively when there's like some sort of decent bid on Bitcoin, and the easiest way to gauge that is just basically like on-chain fees. It's funny how, for a long time, I never really gave half a shit about on-chain fees. But like now I think it is such a big deal in terms of gauging.
They're full of signal.
In terms of gauging the health of the Bitcoin market. Part of me wonders if it just does its own thing. I don't know if that means it necessarily pumps inversely or dumps with it. It just does its own thing. Maybe it really outperforms on the up days for traditional markets and it goes down a little bit while traditional markets go down. But the charts could end up looking drastically different, right? That still is technically correlated, right?
I mean, Bitcoin is a leading indicator, so it's kind of hard to find that. Like, you can only see it after, because you still have to wait for traditional finance to sort of like follow up with their move kind of thing. At least it's been true. I think that's going to change. It could also just not dump or go up, right? It could just sort of stay because we don't have a lot of spot Bitcoin available, right? There isn't. We might not have pockets.
And that's the thing, when you're pulling coins off exchanges, which we've seen shitloads of, you're not selling it on Uniswap. You know what I mean? Like when you're pulling coins out of an exchange, they're going into a wallet, so they're not for sale.
Another way you could look at it as well, in terms of like how Bitcoin's going to respond if like all this stuff dumps really hard as well, is that you have to think about it from a trader perspective, right? Because people say like I think Checkmate, I think you say this, is like the hodlers push the long-term current, but short-term the bounces up and upwards and downwards happen from traders, basically, right? So it's a pretty bold trade to take when everything's just going to zero, to be like, all right, well now I'm definitely going to get super long Bitcoin. It's a pretty it takes a little bit of arrogance to some extent to make a trade like that.
I mean, one of the coolest things that ever came out of the FTX and the Luna and all the Celsius and Jesus Christ, I forgot the name of all the idiocy that just happened, is that for the longest time Bitcoiners have been screaming, get your coins off the exchanges, right? And the numbers now are staggering. I mean, it is amazing how much coins are coming out.
200,000 a month.
That's it. Like, and what's the percentage from previous? I think it was like 20-30%, right?
I had this a second ago. So pre-FTX, there was 13.1% of all coins on exchange. Now we're almost below 12. So we've seen 1.1% of the supply flow off in a month.
Amazing.
Yeah, and that day where FTX collapsed and the exchanges collapsed, that was the day when 10-year supply past the exchange balance. So there's now more coins that have been held for a decade idly on the network than are currently on exchanges. Those two passed on that day.
I mean, you can't deny. I mean, like even if you don't care about self-custody, even if you don't care about Bitcoin sovereignty or any of the other properties of Bitcoin, just taking the coins off the exchanges means you make the assholes pay extra for it, right? Like pay a premium for a spot. I want to see Bitcoin having a premium for a spot the same way that physical gold does. I mean, if you want to buy physical gold, especially when the world is weird, right, you're going to pay like 10, 20, 30% premium on that bar, right? That Bitcoin should be trading like that. It is still strange to me that it doesn't have a proper premium on spot.
A lot of the market still treats it like a highly interest rate sensitive speculative asset, regardless of what we may believe its potential to be. Like that's how a lot of the other normies treat it, especially in this last cycle. Historically, even though it has a higher beta and it hasn't always been so tightly correlated to TradFi like it's been since March 2020, it has always followed the credit cycles and the PMI cycles, generally speaking, like broad directionally speaking. Bear markets happen when PMIs are contracting, when the economy is not so great, when credit spreads are widening. And then when those things tighten and the economy is doing better and there's PMI expansion, Bitcoin's having bull runs. It's a really clear relationship over like 10, 12, 13 years. And so that kind of informs my base case about what I think Bitcoin's capable of over the next year, because those things are going down. The BMIs are now in contraction. They usually stay in contraction for a while. It could be another year or so. And that's also, I think, why it might not decouple, in any kind of way. If we have this hypothetical crash scenario that you asked about, MVK, a few minutes ago, like I think that if something happens, something calamitous happens, and the markets just truly shit the bed and they go way down, Bitcoin will probably go with them. But what I believe is that on a longer term scale, like this decade and looking out into the 2030s, there's kind of an unavoidable scenario that most sovereign governments are going to have to deal with, and that's printing their way out of their debt trap, their debt spiral that is unavoidable at this point. I don't think enough people understand it. It's pure math.
Oh, no, man. I'm a believer that these guys...
You guys do. Oh, but most people don't.
These guys can come up with stuff, man. Like, it's amazing. They'll come up with a new name that puts under a different rug, and they can continue another 2 to 5 years.
It's all debasement. And if you look back, hundreds of years, you go back to ancient China, constantly sovereigns destroy the currency by creating too many claims on the economy. It creates a massive bubble. There's an economic crash. And then for a period of time, when it's bad enough, the people reject the paper currency and they go back to things that have real world value and a cost of production. They go back to rice and metals and food. And now there is a digital commodity. So I think that is where Bitcoin stands to benefit. I think that it doesn't happen yet. I think I hate to say it this way, but just the way that history works, these things that transition doesn't happen until something bad enough happens that it destroys the faith in the paper. And we haven't gotten there yet. We Bitcoiners are on the bleeding edge of that 100%. Curve.
I agree with that. And the other thing that I've noticed is I've watched my currency, right, the Aussie dollar, I watched it get absolutely slapped in March 2020. And here I am 2 years later watching the same fucking thing falling off a cliff again, right?
No, the Canadian peso is now following the Australian peso. We can't call it dollars anymore. I've renamed them personally.
They're all pesos.
They're all pesos now. I mean, seriously, let's be realistic.
All these G7 pesos, people are starting to realize that they're shit, and their wages and their inflation, like the US, you guys are remarkably insulated from this because you're exporting all your inflation to us.
That's
Thank you very much.
We have been, and I think that's about to change over the next few years. That dynamic has changed.
This is the thing. The US dollar is still the best shitcoin.
It is.
And this is what I think like all the crypto people, all the Bitcoin people miss. When you are not an American, the best next thing that you want is the US dollar.
Yep.
Right? Like we still want your inflating shitcoin.
That's why stablecoins are so popular in developing economies.
3 out of the top 6 are stablecoins.
Yeah. Emerging economies use stablecoins for that exact reason.
Well, it's because it's the unit of account, right? Like, and it's enforced by the gun, right? So it kind of works. I mean, it's a lot of proof of work in that. proof of bomb, whatever you want to call it. But what's really interesting is that you can look at Bitcoin a little differently, right? You don't have to look at Bitcoin from a financial perspective. You can look at it as a technology thing, right? And then you look at Bitcoin from an adoption curve. And we're still on track. We're still hawk sticking here, right?
Hash rate's still going up in the bear market, baby.
Exactly. It is absolutely remarkable that we have this thing like pure SLA, right? So there's no flaws in the system, nothing breaks, still working, doesn't matter the economical outlook. It's gobbling up power like there's no tomorrow. So hash rate's going up. Guys are buying more gear. Guys are getting more mines up, even at cost, right? Because they already signed the contract. So I might as well, mine at a small loss or whatever. So then you look at this adoption curve, right? You look at everything around it. The laggards, right? Like they don't come into the technology until the very end, right? And it is really hard to sort of know in the hockey stick, what part of the stick, not the bottom part. How do you call the bottom part of the stick?
The handle. I don't know, the handle, the paddle.
Well, no, what's the bottom of the hockey stick?
No, like, the plastic part of the stick.
I'm from Georgia, so I don't really know much about hockey.
I grew up in Brazil. We don't have hockey.
I'm from Texas. We don't do hockey.
Yeah, I'm in Australia. We have no ice.
So I live in Canada, which we do, but I don't play. So anyways, we're past the plastic part. But I believe we're still in the very early beginning of the wood part, right? So the actual stick.
Very scientific terms we're using here.
Exactly. Thank you.
Yeah.
If you want to look at it a different way, I guess I'll sign off with this. Is that Bitcoin's kind of like a wholesome asset in a period of escalating degeneracy, basically, right? Nonstop money printing, morality being thrown out the window. We're realizing more people are either stupid or dishonest than we thought before. So buy some Bitcoin and
Stack sats and stay humble. I mean, like, like Matt's like line, it's actually it's quite profound because it addresses everything, right? You have this pristine asset. By the way, Perma, thank you for coming. You stick around as much as you want, even if you can't talk, but thank you. I really appreciate you coming.
See you, mate.
Later, Perma.
So you have this pristine asset, right? Which just never existed before. You don't have a thing that survives violence, right? How do you even price this thing? Like there's like, the idea that we're all doing like commerce with Bitcoin and we're using the spot price on Forex, because that's what exchanges are, right? Exchanges are just Forex leverage stupidity, right? It's just that Forex for normal currencies, it's like, you do 1,000x leverage because it only moves a basis point in an hour, right? But like, with Bitcoin and crypto, like it is 4x, and you should use that model. And us as people who are in this a little bit deeper and have like, our lives a little bit mostly in Bitcoin and all this stuff, like we can't price it and we shouldn't be paying spot 4x on like normal daily use. Nobody does that, right? In any other market, but until we have a bigger size, it would still be extremely volatile because it is fixed supply. That would never change. But we need a better way of pricing it, right? And then the funny part is that the pricing part is a lot more social than people think.
No, I agree. And you actually see this over the long term. We were talking about on-chain activity earlier on. And like even during the bear markets, it's like a slow linear grind higher. You just still have more hodlers, more people staying humble, stacking sats. And there's no question you can see the bull markets. They stand out like a sore thumb and they get mostly flushed out, but not completely. There are more Bitcoiners at the end of every single bear market consistently on chain all the time. So there is this stable floor of guys coming in. And I think that's where that social element comes in, right? And furthermore, we mentioned earlier that people just don't realize the pain of like self-custody until they lose their coins. So my orange pilling moment was Pete McCormack's podcast. He did a series on Mt. Gox. And the thing that kind of flipped my switch was like, okay, so these guys, back when Bitcoin was worthless, right, in terms of price, They were willing to fight tooth and nail to get any claim over those Mt. Gox coins. And you start to realize like the technological constraints and all of those things. But like that podcast didn't exist when I started, right?
There was nothing. See, people don't understand this. When I got into the space, like there was a paper on Slashdot. Okay, that was it. That's all that there is for you. And then you went on IRC, right? And then the way, like, there were no exchanges. Okay, like you had to go on this IRC channel that had the price. And then you go meet with a guy on Starbucks and you give him a few like dollar bills, right? And you exchange it that way from a laptop to a laptop kind of thing. So like there was nothing. There was like I'm still economically ignorant, but like boy, I was ignorant. Like we had absolutely no clue. The narrative of store of value and these things, they were not that clear. Like, you know,
and now you've got podcasts of some of the best minds in finance talking about it once a week.
Exactly. It's like, I still remember the 2013 conference in San Jose, right? Like people were still debating if Bitcoin was a separate asset class or not. Like this is like, Trace Mayer was one of the first people who actually had a concise store of value, never selling sort of like narrative, like in about 2012. We all thought like Bitcoin is this cool payments thing because that's what you do. Like, it's worth nothing and you send from here to there. And that's how everybody built and behave around it. I mean, I made payment terminals and debit cards for Bitcoin 2014. It was idiotically early. And people were using it. We're happy to do it, right? But like very few people understood that. The education level was very, very raw. It was mostly people who came for the technology.
Honestly, MVK, like people's education level about money, period, is very raw. And it has always kind of been that way. There's still Americans that think the dollar is on a gold backing. And, that hasn't been true for decades. And so I think that monetary knowledge takes a really long time to develop. Institutional memory about market cycles is very poor. And so when you combine those things, like it takes a long time for people to learn about something's value. Unfortunately, markets they teach in the most Darwinian way, which is really savage, but it also can teach the best lessons, I think. And it's, education is great. We can try to inform people as much as possible, but I think, the market will teach itself.
I mean, money is really, really complicated, right? I mean, modern,
modern money is,
the MMT guys killed gold, right? I mean, they are that talented. Right? Like, I mean, this is not a dumb enemy, right? I mean, they behave stupidly in short cycles, right? Because they're run by, there's a lot of morons involved on 4-year cycles of re-election. But like, when you look at it a little bit like bigger picture, I mean, the fact that this guys killed gold is absolutely remarkable. Right. And the fact that they managed to survive crisis after crisis by essentially selling the kidneys of their grandchildren. Right. I mean, it's immoral, it's whatever, but like it is also brilliant. Right. I mean, and they managed to keep they keep on passing the ball. Right. That's why I don't discount the possibility of that. I thought 2008 was it. Like, and
a lot of people did.
1 year later, I mean, like, like nothing happened. You know what I mean? Like, except for the escalation of asset inflation and all this stuff. But we, as the people living in the moment, don't truly feel those differences, right? Unless you are, lower income but even then, there's a credit card available, it is, I don't know, it's just fascinating to me how far these guys can take things.
Yeah, and the pathway to, like, you're talking about how it's we need to find a better way to price Bitcoin and like what is it really worth, and I do believe it should be thought of in a Forex model, and in Forex everything is relative. The value of a currency is only relative to all other currencies, right? And I think that we're a long way from Bitcoin being thought of that way, but us here on this call and the people who are going to listen to this, they are, like I said a few minutes ago, are on the kind of bleeding edge of understanding of the way that these cycles go. But I think the thing that can be really frustrating and that I see a lot of Bitcoiners get wrong is the belief that we are literally on the edge of the destruction of fiat. And that is not something that I believe in, that I subscribe to. I'm happy to be wrong about that. I'm positioned to be wrong about that. But I think it takes a lot longer than the average Bitcoiner believes, than the average narrative on Twitter would have you believe. I mean, if that narrative thinks that we're in a long-term Weimar type of trajectory, well, if you look at the Myrmicon chart of the value of the Weimar marks to gold,
I love that chart.
It does this, but it takes like a decade of doing this before it really hits the hockey stick, right? And so I think we're somewhere in the middle.
And the gold bugs have been literally predicting this for decades, right? Peter Schiff is the way he is because it never happened.
I know, right?
He's right. He's right about the thesis, but it never happens.
If you look at the holdings of world central banks and you look at their gold holdings versus their dollar treasury holdings from 2014 to now, they have reduced by several hundreds of billions of dollars their treasury holdings and increased likewise their gold holdings. So it's almost like the sovereigns can see some of this coming. Maybe they don't, maybe they haven't pieced it all out, but the effects are there. The initial forces are starting to push them away from the dominant fiat and more towards, a real asset, whether you believe in gold or not. It does have a value to some people.
I think it was 2013, Canada sold all its gold.
They did.
Australia too.
Like everything.
Yeah.
But, it kind of makes sense, right? Because there is no point like holding that gold as a nation who makes gold, right? Like digs out gold, because the real gold money is made on the stocks, not on the asset, right? Like, I mean, the gold holders, the asset gold holders are the suckers, right? Like, and this is like a running joke in the gold finance sort of like environments, especially in Canada, where we have like a very weird, essentially all the gold mining stocks are shitcoin stocks, right? But for gold, like this guy's we have now with crypto.
Gold is useless for the holders while the fiat system is still functioning. But I would not that I'm not a gold bug myself, but to kind of parrot their talking point, they believe similarly to what Bitcoiners believe. They just don't think Bitcoin is going to be the choice. They think gold will be the choice, and that their holdings, their physical holdings, will have value in that future scenario. Of course, they've been waiting for that for decades.
But see, this is the thing, right? And I think this is the part of the knowledge and narrative that's been missed by most people, is that gold lost. Like you need to look at it for what it is, right? Like you had a battle for it, right? You had a dominance. And normally when something gets killed, it doesn't come back, right? That to me, even if Bitcoin didn't exist, right? Like that to me is a much like healthier framework to look at. It's like, it's dead. Okay, if we do end up with something else, it's going to be something else, because after it dies, the whole market, everything else sort of evolves into other ways of doing things that original thing doesn't fit anymore. It doesn't have Lindy anymore. It doesn't have market fit. It doesn't have like any economies of scale and the solutions around it, right? Like people don't have a safe at home for gold. How are they going to buy gold to store gold at home? Right? If gold becomes magically back again, right? Like it's just, all the infrastructure is no longer there, right? And then if you go back to gold.io, you're going to get killed again, right? Like Bitcoin is just like this thing where like it comes and it takes the cake. We saw this with like Liberty Reserve and eGold. If it wasn't for a state attack because the technology wasn't ready and the way it was done, it was not ready, right? Those things saw super rapid adoption. Right? I don't know if you guys are familiar with Liberty Reserve and with eGold. Like these are essentially pre-Bitcoin history sort of private monies. Liberty Reserve guys were like, of course, like everything new in finance ended up like very entangled with the illegal stuff. But they did have essentially free banking and like a new monetary system that was dollar-based, right? And then the eGold thing was the gold IOUs and that stuff. So I highly recommend for anyone listening now, the Nakamoto Institute, our friend Beatstein, has a page. They essentially have a massive library of papers there. There is the Bitcoin prehistory category section there. It is absolutely amazing. Like everything that you think you know, somebody wrote a paper about like 20, 30 years ago. It's like a must read.
That thing you said is so true as well. Like monetary history gets forgotten a lot. A lot of people think things that are happening today are new, but they're the same things that have been happening over and over again.
Well, it's because it's the same set of incentives, right? I mean, like, you know, Joe needs to buy potatoes, right? So you're going to have your normal barter, and then your normal sort of like you're going to find some better thing to be the money. And then that money thing is just not secured enough and is going to get inflated by the guy who can. Like there's no like secret to it. Right? Like it's like this happened like since the beginning of the shells, right? Like it's just how it works. So like the beautiful thing about Bitcoin is that it resolves the inflation problem, right? By having proper protection on the proof of work that scales with the size of the economy, right? Like this doesn't exist except for the US Army, which inflated with the size of the US balance sheet, right? Like, I mean, the USD grew the size of its military with it, right? Like, and that's its proof of work. And then comes this Bitcoin thing where the protection grows in the same trend as its value, right? You don't have anything else on earth that has the same properties that is capable of essentially having these two things follow each other so that they don't get cheated. But anyways, it's that's Bitcoin for you. I guess like going back to chain analysis, you know, we're going to be wrapping up soon. I have a few more questions here from people, unless you guys have any other sort of like comments on the previous topic. Cool. So, for example, OpenDime and SatsCard, right? Bitcoin All Caps asks, like, do off-chain privacy enhancing Bitcoin swaps with devices like the SatsCard and the OpenDime defeat chain analysis timing heuristics or other heuristics? What are the implications? And I can tell you this for a fact. Like I've had customers contact us with thousands of coins in those devices. And I've very clear advised not to do that because it doesn't have a backup. But these guys have been able to trade these things, you know, without any chain imprint, right? Like there's no chain impact. So, you know, I see a world in which, you know, a large chunk of players that have a different sort of trust model can operate completely in the dark.
Totally. No, and that's the thing. Like the way to think about it is, and I think you said this point before, TX. We're not trying to track the individual, right? So there's going to be trades. It's never going to be perfect. It's always going to be imprecise. But at an individual level, there's noise. At a macro level, none of this stuff matters, right? You see the aggregate behavior because the vast majority of people are not going to be trading 1,000 BTC on a Sats card. They might be trading 1% of a Bitcoin. They probably won't be trading 1,000 Bitcoin. So that 1% is kind of irrelevant.
Because, you know, like, for example, Iran drives their gold to Turkey in trucks, and then they get USD trucks back, right? Like, that's their shtick. That's how they do their economy,
that's their blocks.
Right? Yeah, it's a blockchain of trucks. No, but like, I can see this sort of like mid-grade state actors, right? Like sort of like having essentially like laptops, you know, with a big like 1K BTC written on the lid with a Sharpie. And then they have a stack of these laptops, right? And then you open the laptop, you know, you put in a code and it just proves that it's there. And, you know, you have a certain understanding because you can always bomb each other. And you just trade them back and forth to clear your balance sheet deficits, right, with each other. So, you know, and you can leave completely dark.
Sovereign wealth on an open dime. I love it.
That's the dynamic we were describing earlier, like when I was describing what Fireblocks is doing in the commercial bill of credit system. That's almost the same thing. You know, you each know that you have holdings. Maybe you trade some of them offline, and that doesn't really get registered on the ledger, so to speak, but there was economic activity occurring. But in the aggregate, those things kind of get parsed out, you know, at scale. And I think there was something that Permabull said earlier that I didn't get a chance to reply to, but he was so right. And it's the absolute values mostly don't really matter. You know, like maybe for certain metrics they might matter, but like the total supply or whatever. But the actual on-chain metrics that we use in a lot of cases They really are about the momentum and the direction of change and the rate of that change. And that's how we really assess the health of the market, the strength of it, whether it's in a good place, whether it seems to be declining, whether adoption's picking up. That's the way to look at it. And to kind of tie it to a question earlier about on-chain analysts being macroeconomists, that is how you look at the macroeconomy. You look at it in rates of change. You don't look at it always in absolute values because economies of scale grow over time and the laws of big numbers come into play. It's really about rates of change and rates of change at points in time, compared to previous regimes. So like that's the way you kind of have to look at it. And I think that on-chain could retain value in that way, even in a future where we have mid or larger actors performing a lot of activity that isn't on the ledger directly.
And furthermore, like it's like saying that as the economy gets more complex and we have more types of transactions and, civilization progresses, that people become less capable of understanding that, which, I mean,
it's never a vacuum.
It makes absolutely no sense. So, use the right tool for the right job at the right time and you'll be fine. And this is the same for any profession. So again, I do find it funny when people poke fun at on-chain. They're like, it's just voodoo. It's like, well, so is everything you do. If you don't bloody practice it, if you do some kind of proof of work, you might find that you can actually do some damage with it.
Well, some of that voodoo got attracted in the bull market.
Big time.
A lot of that voodoo came up in the bull market because there is always a new narrative conjured to justify price, whatever that price is. And in the bull market, you get a lot of hopium stories, and those metrics, they're amazing. They provide a level of depth and insight into psychological market behaviors that you just don't have anywhere else. And so it's natural, I think, people kind of see those things. They see lines going up and to the right, and they attach it to what they think is going on in the bigger world. And a lot of those narratives maybe aren't true.
And the perfect example of that, actually, TX, you probably saw this. People will look at like Coinday destruction going up, and they're like, no, look, it goes up in bull markets. It's like, yeah, that's the old guys dumping on your head, mate.
You're getting sold on.
You're supposed to have bought the $3,000 Bitcoin, not the $60,000 Bitcoin. But they're like, it goes up in a bull. It's like, yes. And it goes down after.
I think this is the first it's the first time in, say, this last few years, right? It's the first time that sort of retail is exposed to charts and exposed to financial terms and is exposed to day trading.
Yes.
Leverage.
Like when I heard about people doing on-chain analytics for some of the price stuff, I'm like, like probably a bunch of TA guys, like doing a bunch of idiotic, inferences, the proverbial male astrology. So I think what you guys are doing is very different than that. And I think just that like the larger sort of industry still sort of starting to understand now that this is a trend finding exercise the same way you try to predict other things, right? Like, earthquakes or whatever. You're just looking, if whatever data you can and just trying to create a trend.
The secret is to understand that it's economics. You can use it for short-term trading, no question. But again, if you don't understand the climate that you're in, when a rainy day shows up and you're surprised, well, that's because you don't know what the climate is. So, you can use on-chain to help you set that big picture view. And you can also drill down, look at it on a shorter-term intraday, daily basis, right? But as with all things, there's a right tool for the right job. But yeah, I think a lot of people think that like chart go up mean price go up, and it just doesn't work that way. Nothing works that way, because otherwise we'd all be rich.
I have a good friend, Matthew, who's been doing on-chain analysis on base money. I don't know if you guys know Crypto Voices on Twitter.
Oh yeah.
So by the way, that it would be fantastic to see analysis of base money versus all the charts that we have for Bitcoin. I'm sure there is some interesting correlation there, but it's fascinating that, for traditional central banks and all this stuff, like it's completely opaque. But when guys like Matthew go in there, they actually find it. They find the baskets. They find he has a very good picture of like the actual size of the balance sheets and the size of the monetary supply that these governments have. So, I guess in our industry is even easier now, right? Because a lot of the stuff is there. I guess with that, I mean, we can start wrapping up. This was a lot of fun. Thank you so much. You guys are a bit of a wealth of knowledge there. So any final thoughts, TX?
Well, thanks for having me on, MVK. I've always wanted to get to meet you, so that's pretty cool. I've got my block clock sitting right over here. You can't see it, but it's sitting right over here.
I got two of them. I got the micro and the mini staring me at the face. One's got soap on it right now.
Yeah. So I love talking about these things, and Check and I are good buddies. So it was pretty cool when I didn't know who I was being asked on here with. And when I went to the schedule and I saw it was Checkmate and Permabull Nino, I kind of did a little dance. That was pretty cool. Now, this is a fascinating field of study. You know, on-chain specifically is also pretty new. You know, it wasn't around in the prior bull market really in any capacity like it is now. Maybe just one or two metrics existed. Like the concept of a coin day was still really early. And so I think that there's going to be a lot of things that get thrown at the wall that maybe we find in the next cycle we don't really want to look at very much. You know, I certainly the metrics I look at today have changed a little bit from a year ago. You know, I think that that's kind of the natural evolution of being an analyst and also the growth of this space happening at the same time. So that's something I always like to caveat for people when they ask me about on-chain and how I use it. It's changing all the time.
So the bottom is in.
Right. But I don't think the bottom is in. I don't know where it is. I think that's heavily macro.
There is no bottom.
Yeah, there is no bottom. Yeah. Negative pricing.
But we're below realized price. We're below the 200-week moving average. Every single on-chain metric that calls a bottom has bottomed. So if you're looking for value and you don't mind price going a little bit lower, we're in that zone. So take that for what it's worth.
We are not overvalued is the way that I would put it.
We are far from overvalued.
We are not overvalued.
Before this, I used to have this very funny sort of like as a joke rule of thumb. It's like, I can always tell which way Bitcoin is going to go because whenever it's dumping on the weekend, it means we're underpriced. And whenever we're pumping on the weekend, it means we're overpriced. There is no way to know the middle. That's the problem. Don't trade on that stupidity, please.
My candlestick charts are just Saturdays and Sundays from now on. I don't even look Monday through Friday.
Yeah, no, it is a fascinating market. And yeah, I mean, it's going to be very, very interesting to see what happens to DCG and Genesis and all. I mean, those guys have the cash outside of those structures, but if it's going to come into those structures or not, I'm not very concerned. You know, one bankruptcies take, you know, a decade, especially of that size. Then, you know, I don't see anybody buying Bitcoin at a discount and then selling on the bottom either. So like that would be idiotic. And same with the Gox coins, like, you know, like if they came out at the peak, that would have been a problem. But like, you know, we all know when they announce the coins are coming, it means another year.
And those people are forced multi-cycle hodlers. And if they are awarded their coins in the bear market, they're probably going to hold on to most of them, I would wager.
They've already got over that loss, right? They wrote over that loss. And
it's a bonus.
They might sell a few of them just to make some money after years, you know, but I would imagine most will sit until the next bull.
So guys, where can people find you and what should people, do you guys have any projects that people should know about or anything's going on that you'd like to let one or two people know about?
I'll give my piece and then I didn't let Chet give his last words. So you can find me on Twitter at TXMC Trades. I also write a newsletter and I have a YouTube channel. Both of those links are in my bio on Twitter.
Awesome.
Cool. Yeah. So look, in terms of like contextualizing everything, what we were talking about before, on-chain does require a little bit of proof of work, but it's a little bit. It's a hell of a lot less, right? The same way that we have podcasts and macroeconomists and all this in the Bitcoin space, which you didn't have in 2013. The whole project that me and my guys have been pushing for back into this year is our dashboards. And the reason is the comment was people like, I don't know which tools to use. So we put them into groups. When you're looking at on-chain activity, you go to the on-chain activity dashboard and it has all the tools and all the magic that we've baked into it. So the whole point is to make this stuff accessible and digestible for everyone, right? Because, you know, when you see someone laughing on Twitter with an on-chain chart, you've got literally a text box and the chart to go and prove it yourself, and you can look at it. We tell you what it means, and then you can make your own assessment. So that's that's been our mission for this quarter. So hopefully that's useful for people. And you can reach me at @_Checkmate. And yeah, feel free to ping me if you've got any questions on-chain, Glassnode, or anything else.
Yeah, no, it is true. Checkmate does answer questions. I have asked him a few. So guys, if you have any links, just let Johnny know, and we can add them to the show notes. They go with the thing. Thank you so much for coming. This was a lot of fun, and I hope I can maybe we'll have all you guys again, and we can come up with some other once Genesis crashes, or the next thing, we can all discuss it.
There'll be inspiration, I assure you.
So just in the next few days, right? That's what you're trying to say.
Yeah,
that's right.
Actually, I put out our last newsletter, week 50, and I said in there, like, short of any market moving something that just blows everything up, I'll see you in January. So please, just if Bitcoin could just stay calm for a couple of months, I need a couple of weeks
Give
off.
Checkmate a couple of weeks off.
Yeah, Bitcoin
Please.
never does what you want it to do.
Yeah, I know.
The market levies a steep tuition on everyone, and that's one of those lessons for sure.
I mean, we're literally building businesses that are a beta on a beta of the traditional finance. So good luck with having a little bit of peace.
Yeah. What it does do is build resilience.
Oh yeah,
builds a lot of character.
Oh,
you know, I was saying this just I think was yesterday. It's like, I don't think traditional finance and the normies, as we like to describe them, understand that people are literally laughing right now and accumulating. Like,
yes,
this is not a joke. Like, people are smiling. I know it sounds weird to you who think the world's gonna collapse, but we're all actually building and are happy, and there is capital available, and it's like a thriving industry, and people are hiring.
And some people are secretly hoping prices stay down for a little bit longer.
Yes. 100%. No, actually, and that's always been my personal. So I bought the very, very tippity top in 2018, right? In fact, it was so bad because Coinbase had an extra tax for Australian dollars. So my first buy is actually above the top of the chart. But anyway, my lesson learned was that there is a pain to the upside when it just starts running. And that 2019 moment when you realize you didn't stack enough, when I start to feel like down is actually superior to up, we're getting close to some kind of a low.
I bought every top and I bought every bottom, and it averages out, and the amount of coin you're gonna lose along the way, that you're gonna make bad investments, that you're gonna do something that it seems right, it just works out that way.
Yeah. It does. I actually bought the top of the bear market in 2018. I bought in late January and I sold 2 weeks later, and I didn't come back to Bitcoin for 2 years because I didn't know what the heck I was doing. I didn't know. Everyone gets BTC at the price they deserve. And the funny thing is that first coin that I ever bought would have been underwater if I was still holding it now. So would have learned a lesson either way.
The bear market of 2014, essentially everybody who had a Bitcoin company nearly broke. It really is that simple. Everybody had to spend coins to maintain their businesses and have a life and do stuff, and maybe it's never going to come back again, right? It was small enough, it's that's just how it works. Mm-hmm. So stacking sats is a journey, and we're still so early because again, when Bitcoin goes anywhere, you would have to be literally $5, 10, $20 million per coin, or it does not address the market. And by then we probably already lost 50% of the coins to people getting locked out of their phones. So it's just so silly, right? That a coin today is a substantial advancement in your economic capacity in the future if this experiment works. It's being proven to do okay so far.
Yeah, and it still has the most asymmetrical upside of virtually anything else on planet Earth. So I think that we still have a long way to go.
Yeah.
Yeah, agree.
Well, with that, guys, thank you so much. And I'll have you around. Thank you.
Nice one. Thanks, mate.
Thank you very much.
Thanks for listening. Don't forget to follow @Bitcoin Review HQ or get in touch on Telegram, Bitcoin Review Pod, or bitcoinreview@coinkite.com. We don't have a crystal ball, so let us know about your projects. Leave your Boostagram on this episode and we'll try to read it on the next episode. If you don't know much about Value for Value or Bitcoin Podcast 2.0, go to bitcoin.review/V4V.